Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition of Market Guru, and the person who's joining in on this special edition is also a very special person, and he's a market veteran as well. We are now joined by Mr. Prateek Agrawal, the MD and the CEO of Motilal Oswal AMC. Warm welcome to you, sir, and thank you so much for taking the time out for this special discussion. Well, it's an interesting time at this point in time that you join in, sir. On the one hand, we were celebrating levels of upwards of 25,000 and everything was going hunky-dory till the time the global market mood also soured a bit. There are emerging now concerns about what will happen as far as the recessionary fears are concerned in the US. What could that do to the overall global markets as well? And now we are of course keeping our fingers crossed, looking at what the US Fed will do as far as the rate cut cycle is concerned. Back home, of course, we are again looking at whether we are at steep valuations at over 25,000, and all of these scenarios are somehow unnerving the investors at large who were blown with the kind of investments that they were doing in the market so far. How are you looking at the current market setup both globally and domestically, and what is it that you're advising clients as of now?
Okay, let us simplify things. Let's first understand growth. In valuations, two things go in. One is growth in earnings, growth in economy is the driver of that, and then the discount rate. Now, if the US slows down and China has been slowing down, yes, global growth can be expected to slow down, but global growth is in the vicinity of 3.5% anyways. A 1% slowdown in a global growth impacts our growth by 0.18%, given that our exports are just about 18% of our economy. The flip side is lower global growth results in lower oil prices also. So you have noted Brent to be now closer to 70 versus being closer to 80 just a few days back. And a dollar lower there saves the country 1.2 billion on a run rate basis per year. So it is, this slower growth versus savings on the oil tends to cancel each other is the small point. So the growth outlook doesn't get impacted much for the country. Now, if the growth stays motamoti what it used to be, and you are getting a discount rate cut because in response to a US interest rate, US economy slowdown and inflation coming in control and jobless data not being so good, you expect Fed to cut rates, so you are expecting yields to move down. Lower discount rate means higher valuation. So yes, while it is happening, there can be a period of turmoil in the market. It always happens, but over a period of time, it results in higher valuations for the market for growth assets, and within growth assets like equity spaces where earnings growth quotient can be an order higher is the other thought.
Now, Mr. Agrawal, but do you, what will you say to the underlying fear of a bigger and a deeper correction could be underway? Do you think there is a possibility of that? Because all across this calendar year or this fiscal year, we have seen that the markets have been able to digest any and every negative that came its way. In fact, it bounced back strongly. It showed a lot of resilience thus far, whether it was the geopolitical crisis, whether it was the elections, whether it was the budget. It was innumerable events, and all of them got digested, and every time the Nifty came out much stronger. There are again fears lurking that the markets could now be entering into a longer time correction, maybe if not a sharper price correction. What is the sense that you have?
So 3 to a 5% correction is a good correction to our mind for buy on dip kind of investors. We say this because versus 2008 to 2020 period, when let's say a large cap index earnings growth CAGR was just 4-5%, which means on a quarter, your earnings growth related valuation correction was just 1%. all of the correction had to be price driven. Today, when your earnings growth CAGR is between 12 and 16%, depending on which part of the market you are looking at, the quarter earnings growth driven correction is 4 to 5%. So what used to be a 10% correction in 2008 to 21 period, and which is what used to cause a lot of fears in the minds of the investors, is more like 4 to 5% correction in this period because the underlying earnings growth trend is so high. So we say, 4 to 5% correction is good for rebuilding portfolios. Now, lot of the thoughts, lot of the reasons of volatility, which used to be global in nature in the past, continue to be there, but they don't impact us as much because there are two ways in which influences of outside come into the country. One is the effect on policy. So if US Fed increases rate or decreases rate, RBI, looks to follow suit. Now, this time around, if you see our forex reserves are all-time high. If you have high forex reserves, this linkage breaks and our central bank gets a degree of freedom more. So this influence of outside into India reduces. The other big influence of outside into India is through the linkage of FPI flows. Okay, but over a period of time, that influence has reduced. Our markets now are moving more on account of very structural domestic flows rather than getting impacted by offshore, volatile offshore flows.
Okay. Now, sir, as you've also announced recently that Motilal Oswal Asset Management Company has an assets under management which has surpassed 1 lakh crores as of August 26. You've also announced that over the past 10 years, from April 2014 to April 2024 or to August 2024, your AUM has expanded by 50 times, along with major expansion of the customer base, which now stands at 32 lakh with about 200 plus locations where you're catering to. So looking at all these data point, there is definitely no dearth of liquidity that one can spot. Liquidity is a buzz. People want to invest. They have found this newfound love with the Indian asset class, that is stock markets, by way of maybe mutual funds or directly. But there is a lot of newer and fresher money that's actually coming in. Now it makes the job of people like you very difficult as to at every stage of time how to deploy that fresh money that is coming in by your way. So help us now understand, like you said, okay, 4 to 5% correction, if it comes it will be good. So will you be sitting on some cash, and have you identified a few sectors where the fresh money will first go when this correction comes in?
So let me answer it this way. We are high quality growth focused investors. So the start point of how we start to think is flesh out spaces in the economy where growth in earnings can sustain at an order higher than index as a whole. Because only that growth delta, growth in earnings delta that our managers are able to get for our investors is what is ultimately going to result into alpha, of course, corrected for our mistakes and our valuations. So that is the start point. Now I'll give you one thought process which will make it very easy for your listeners to understand.
Okay.
You know, what you want is a large quantum of growth sustaining for many years. Okay. So I take you back to the mid 90s when software services as an industry started in the country, started to come into the markets and delivered both, strong earnings growth, and it continued for a very long period of time. And if you see, that was a period when managers delivered substantial alpha. That was the golden period for managers. Now, likewise, if you look at past 3, 4 years, you got new tech. Several companies there have come into the market. You got electronic manufacturing. You got this whole renewed focus on renewables, defense, etc. So a lot of these spaces are similarly new, and there are newer spaces coming in. So that is the beauty of this period. Newer spaces, less there in the index, large quantum of growth, sustaining for longer is a great recipe for alpha generation. And as the quality focused, growth oriented investors, our start point is here. Look at spaces where innovation is strong, look at newer spaces. That is where growth delta of an higher order can be there. Yes, if there is a combination of a great management in place, that entity may just do much better than other entities in the space, and which is how we circle down into a name.
Do you also identify any pockets where a lot of froth and overheatedness is being seen as of now? Where would you actually advise viewers to avoid plunging in with their fresh money right now?
No, so if one looks at broad indices, the larger cap index valuation seem very sustainable. The P's are closer to 20s, 10-year averages are there. So it seems to be very, very sustainable. Now, small cap indices keep undergoing changes because something which does very well in small goes to mid, and what doesn't do well in mid comes into small, and so on. But after those changes, the small cap index also looks very sustainable on valuation. It's like 23 times 1 year forward. It is the mid part of the market where valuations seem to be a tad higher than historic, 35, 36 times 1 year forward, significantly higher than other spaces in the market. But then if you see a lot of the spaces that we spoke of in terms of themes where growth can be significantly higher than long period average, they tend to lie now in the mid part of the market. Our whole thought is if the growth keeps coming in, even this part should see sustained valuations, maybe not any large correction. I'll give you a thumb rule. 1% higher growth in earnings sustaining for 10 years, like to like, should result in 5% higher valuations. So a 5% higher growth is 26% higher valuations. So if index which is doing 14 odd percent growth, let's say the large cap index, trades at 20 times, and we think it is fairly valued, and the mid is trading at 35, 36 times, so 50%, let's say, higher valued versus the large cap index. It kind of means that it is building in 10% higher CAGR growth. My thought is that's a tad too much to ask for, and hence I say that's the part where some bit of overvaluation lies.
Okay. How about the IPO space? Have you assessed that and some of the newer IPOs that are coming in? Do you think investors should be, pumping in their money there, or be very, very cautious when they are selecting the IPOs? We have Bajaj Housing Finance IPO that's open today. We had Premier Energies that actually gave stunning listing gains to investors. Gala Precision opened today with a 40% uptick as well. Ola Electric, a month back, it had come in. It had its own share of gains and losses right there. So there are new age IPOs that are coming in. There are renewable energy focused companies that are coming in. There are housing finance companies. How are you really assessing the IPO space right now, sir?
We do look at all opportunities. We do invest into many where we believe money is there to be made. So some of our managers have been part of the anchor book in many IPOs. So that is something that we keep doing. But yes, like you are saying, spaces where we believe trajectory of growth can be very strong, managements where we believe growth orientation is of a very high order, clearly come up the list versus value plays. Because, just remember this, when you look at us, we are very high focus on high quality, high growth businesses rather than the other style, which is trying to find value in the market. We are growth focused investors.
Okay, got it. So that's the view that's coming in. Well, we will thank you, sir, on that note for sharing with us all these thoughts and ideas. Overall, the sense of, how should one be viewing the market setup and what should be the ideal strategy at this point in time, the key risks right there and the key parameters one should be looking at while investing. Always a pleasure to hold such experts who have massive insights into the markets and can share that wisdom with our first time and newer investors who are actually coming into the stock markets. Thank you.
Thank you so much.
Thank you. All right, with that, viewers, we will wrap up this very special edition of Market Guru, but continue to stay put with us on Business Today Television. We will continue to get you more insights from the world of business and stock markets.
Battle for Haryana heats up. Congress-Aam Aadmi Party alliance is stuck amid hectic bargaining over seats. The stalemate intensifying with both sides sticking to their guns. Sources in Aam Aadmi Party say it is ready for a tie-up with the Congress party, but will not compromise on key seats like Kurukshetra. If talks with Congress fails, AAP may rope in BJP Congress rebels as Plan B. Aam Aadmi Party MP Raghav